Today we have the stock analysis of Nvidia, the most popular company on the stock market right now. Nvidia had a crazy explosion last year and many investors missed out on the explosion. Some went and started chasing the stock to buy it because it was rising so rapidly. But now we see a little bit of a pullback. So people are wondering, is now a good time to invest in Nvidia? So let's get through this fundamental analysis and talk about the quality company that Nvidia is. So let's get into it. Right now, Nvidia is trading at about $115. Again, we see that we had this crazy surge and right now up 132% on the year. But as we see, we have this kind of downtrend here where it's down a little bit and people are wondering, is this a good time to get in before the stock potentially shoots back up? So we'll get into that right now. Let's first look at revenues. So starting with Nvidia, looking at the revenue growth, we see a crazy amount of growth over the past 10 years, 160% growth, a super hyper growth amount from 4.6 billion all the way to 79.7 billion, almost 80 billion right now, looking at the last trailing 12 months. So we have that growth slowing down some in the last 5 years of averaging 17.3%. So still a very high growth environment. That 17.3 is more indicative of a stable company where Nvidia is. But again, we want to know they had an amazing explosion of revenue growth in 2024. And now we're still in 2024, but their fiscal year ends in January 24. So for their fiscal year, their months goes from February to January. A little bit different, but not a big deal. Just want to make sure you are aware. That's what I'm talking about when I say fiscal year 24 for Nvidia. So from 26.9 billion all the way to 60.9, an amazing growth year there. So we want to make sure we're understanding that a lot of this growth and a lot of the stock increase came from the anticipation that they might be able to continue growing at that 125%, even though that's really not likely. Still an amazing growth for that year. Now looking at gross margins, how efficiency the company is, we see that they started off at 55% 10 years ago and going up to now they're at 75. So not only are they growing their revenues at a solid rate, above average rate, they're becoming more efficient. They have cost savings. Now with tech companies, this is normal as they mature because as they are building their company, they build their software, they put a lot of capital upfront into that software. And then over time, they don't have to reinvent the wheel. So as far as the cost associated with delivering the product to the customer, those costs begin to come down. It's not like a car manufacturer where every year you have to manufacture and put the cost into the car. With a tech company, once they kind of figure out the tech, you'll see that gross margins improve over time. And we see a great improvement of almost 20% over the 10-year period. So a 221% kind of annual growth there, still 17.7% growth in their margins. So not only are they gaining in revenues, they are gaining in efficiency as well. That's great. Same with net profit. 10 years ago, 13%. Now 53.4%. Amazing growth. So yes, this company has great margins and improving margins along with their improving revenue. So that's a great sign for Nvidia. Now looking at the free cash flow. The free cash flow is the cash generated from operations subtracting the capital expenditures, what is considered the required reinvestment back into the business. So looking at the free cash flow, similar to the revenue growth, 783 million 10 years ago, now $39 billion. Amazing growth. So 90% over the 10 years. And unlike the revenues, we see more growth over the 10-year period versus the last 5 years. Here in cash flow, we see that we have more cash flow growth over the past 5 years than the last 10 years. So still an amazing growth rate there when it comes to the free cash flow. And we know that the free cash flow, we have the reinvestments into the company, debt, acquisitions, dividends, and share buybacks. Those are the things that free cash flow is used for. So the more we have there, the more value creation we have in the free cash flow, the more the company can better allocate their funds. So we love free cash flow. Now going to the balance sheet, we want to look at the leverage. How much debt is a company carrying compared to the free cash flow? So how much debt compared to the money that they're generating to be able to pay off that debt? So that's very important. Here we have our debt, 1.3 billion going to 11.6 and then back down to 8.4 billion. compared to the free cash flow. So looking at the debt to free cash flow, we see over the past 10 years that they typically can pay off their debt in no more than 3 years. 2.8 years was the highest that they had in 2023, but right now 0.3. Looking at the average debt balance compared to the average free cash flow over the past 5 years, on average, they can pay off their debt in 0.8 years. So in less than a year, they can pay off their debt with their current free cash flow. That is a great leverage position to be in. So we love that. So another great sign for this company. Looking at this dividend, yes, Nvidia is a popular tech company that is paying a dividend. So we have a 30% growth annual rate for the past 5 years. And I want to make a note. Notice how they were paying this small 0.004 dividend for the past few years, beginning in 2018, and they kept it the same until they had a big increase this year. So this 150% increase in this 1 year, this calculation, I'm looking at the last 5 years. So I just want to let you know, it says the last 5 years dividend growth rate is 30%. That happened in 1 year, this past year, where they increased their dividend 150%. Currently, you're only getting a 0.02% yield on the dividend. So that's not high, but that makes sense for this type of company. Now, we don't want a company to pay a large dividend when they're still in some of the growth state or the mature growth or development stage. Reason is I want this company to be able to reinvest most of the cash flow back into the business and earn high returns on it. Since that's the state that this company is in, they should not be paying a dividend or not paying a high dividend. So they're paying a small dividend, totally fine. There's no threat to the cash flow. The payout ratio, only 1.5% of their free cash flow is going towards a dividend. So it's a very safe dividend, a lot of potential to grow it in the future. But with the type of company this is, they should be able to reinvest at high rates of return. So don't look for large dividend growth to continue with the company like this. If it happens to do so, okay, great. But that's not what you would invest in Nvidia for right now. It's not going to be a dividend play. However, still great dividend policy that I would agree with. So that is a great sign as well. Now going to shares outstanding. This is the only thing with looking at this company that I wouldn't say I wouldn't agree with, but it isn't something that is a check mark. So we want free cash flow going to a portion of the free cash flow is going to buying shares, reducing the shares that the company has. The less shares that the company has, the more earnings and free cash flow that my shares that I have own of the company. So I want to make sure I'm investing in companies that are not increasing the outstanding shares by a large amount. If they are doing it, I at least want the free cash flow to grow at a faster rate than the shares outstanding. And I'm not feeling threatened that my shares are being devalued. I want my shares to grow in value every year when I'm investing. So looking at this trend, we do have an uptrend this year. I don't think this is a bad sign. We do have a downtrend for the more recent years. So we see that they were selling some shares to bring in some cash in 2017, and they started to decrease that amount down in 2024. So overall, in the more recent years, good. Looking at a longer trend, not necessarily a good sign to see the shares rising at this rate. But with the company that's making so much money and generating so much cash, this should not be a threat. Now going to value creation, what I think is probably the most important metric to look at other than free cash flow. I'm looking at the return on invested capital and comparing that to the weighted average of capital. So, weighted average cost of capital. So when it comes to the return on invested capital, they say you have to spend money to make money. So this is looking at the spend and the make and comparing them to make sure that the company is actually earning a return on the money that they're putting into the business. So two sources of capital, we have debt and we have equity. We're going to total that up and compare that to the operating profit after taxes. So looking at that, we have Nvidia at 79% ROI. That is an amazing number. That means for every $100 of capital, debt, and equity that Nvidia has put into their company or has on their balance sheet, they're bringing in $79. That is an amazing return. Cost of capital, compare that to the cost of that debt and the cost of that equity, which is at 9.98%. This says Nvidia is increasing in value by $69 for every $100 that they put in, looking at this past year. That is an amazing rate of value creation. Definitely a positive sign. Now compare that to the industry average of semiconductors. The average industry is at about 18.53% of return on invested capital. And this is a good rate. The 18%, most people like 12 to 15% to be a healthy rate. So semiconductor business, 18.53% in return on invested capital. Great. We see that Nvidia is way above that. On top of that, Nvidia has a lower cost of capital than the rest of the industry. So Nvidia is winning on both of these metrics, and the average semiconductor company is producing 8.15% of value creation through the year. Nvidia is above that by 61 points. That is an amazing advantage that Nvidia has over their competitors. So as an investor, you want to look at their trend here and see if that value creation, or if you believe that value creation is going to continue in the future. So right now, based on the 6 things we looked at, we know Nvidia is a very high quality business, very investable. And we definitely want to, if we're not happy with the valuation right now, is definitely something that's on our watch list to invest in the future if we ever see the price and value at a price where we're comfortable with. So looking at the valuation of the business. Now I want to be careful here. Valuation in and of itself, or any type of valuation metric by itself, doesn't matter when looking at a vacuum. You have to look at what the company is priced at and compare that to the growth rate of the business. Doesn't make sense for the expected growth rate. Now, there are 2 quick ones that I like to look at. The price to free cash flow. I want to know, when I buy this company, how much am I paying for $1 of free cash flow? And also the PEG ratio, the price to earnings growth ratio. So looking at the price to free cash flow, I see market cap of 2.8 trillion and compare that to the free cash flow generation of the past 12 months of 39.3 billion. That means right now I am paying 72 times free cash flow. That means I'm paying $72 for $1 of free cash flow. Now, is that a good rate? Imagine if you have $72 and I have $1 and I say, hey, invest in my company for a cash flow. For $1 of cash flow, you got to give me your $72. If you were to give me that and I give you that $1, how would you feel about that? It probably wouldn't feel great about that exchange. But imagine that $1 that you received in free cash flow is going to grow every year. So your question would be, how fast is it growing? Is it growing enough, or growing at a rate that's fast enough that makes me okay with handing over $72 for that $1? So that's what we're looking at when we're talking about the free cash flow, or talking about price of free cash flow. So this other ratio, the PEG ratio, it says that the price earnings ratio of any company that's fairly priced will equal its growth rate. That is a general rule when looking at the PEG ratio. But you have to be careful, because I think some great businesses are never going to be fairly priced when looking at that ratio, but I still like it as a reference. So the PE right now is currently 63.8. They are projected to growth at about 46.4% over the next 5 years. That means I have a PEG ratio of 1.38. So I would say right now, looking at this ratio, it's slightly overvalued. But when you're looking at how much value this company is creating each year, of 69% this past year, are they going to continue this trend? Are they going to continue to grow at 46%, according to analyst estimates? Another question is, as they're growing, what are the threats to their business? What could happen that will threaten this growth rate and drop it down to 30% or 20%? If a company is growing at 20%, some people may not like the valuation. If a company is growing at 40% or higher, they may say this valuation is totally fine. So as an investor, you have to find the story that you believe in about the company. So you have to read these financials and get into what makes the company what they are and what are the threats in the future. If you don't really see the threats, if you have a good understanding of the business and their competitors, then maybe this is a good investment for you. So looking at this scorecard right now, the only negative trend that I've seen in this business is the shares outstanding. That's the only thing that I don't like about the current state of the business. And even with that, in a more recent 2 to 3 years, we see a trend of the shares going down, which we like to see. So that's not even a whole solid X, because in the recent years, it's doing exactly what we want it to do. But other than that, there's not many flaws with this business. So it is deemed a quality business and 100% definitely worth our time to do more research and figure out if it's something that we want to invest in now or later. So overall, Nvidia is an amazing company. So I hope you enjoyed this analysis. Let me know in the comments if there's any other companies you would like for me to review, and I'll see you in the next video.